Jim Caron, it may be earnings season for stocks, but fixed income managers like yourself still have their eyes on the Fed. So what's your outlook for Fed actions the rest of the year?
So what we think is that the Fed could hike at least one time this year, probably closer to the end of the year, most likely December is what I'm thinking at this point. It seems that based on the recent comments from the Fed, that they do want to sneak one rate hike in just to sort of almost prove that they can do this and that the economy is strong enough to sustain one rate hike, and they want to get off the zero lower bound. So I think one hike by the end of this year is probably what we should be looking for.
So with that in mind, how are you structuring your portfolios?
Well, this is the start of a cycle now that's going to be pointed towards higher interest rates. So one of the things that we think is very important is to have more of an unconstrained mindset in terms of portfolios, which is that you don't want to have the index make the asset allocation for your investors. You, as a portfolio manager, want to make the asset allocation decisions. So effectively, what we think is unconstrained strategies which allow you to be more nimble and cross assets across whether it's interest rates, high yield, investment grade, even currencies to take more active bets. We think that's going to be the way to offset some of what could potentially be a rising interest rate environment and could have some headwinds to fixed income. But with the unconstrained strategies, we think that we can still have a positive return.
You mentioned high yield. Is that a safe place to be after what we saw this winter when a lot of the energy issues really sunk that sector? Could that happen again?
Well, we think a lot of the factors for energy is pretty much well known at this point. Now, of course, we could be surprised. The one thing that we like about high yield is that default rates remain relatively low. So even though the Fed may start hiking interest rates, we don't think they're going to be tightening. We think what they're really doing is just removing excess accommodation, and they're just moving to a very accommodative period. So high yield with low default rates, with a higher obvious overall outright yield, we think can still be a pretty decent place to put your money. You have to be a little bit careful. We're not going to go headlong into the energy names just yet, but we do think that there's value, particularly in the more retail and consumer cyclical side.
Another place where you could grab some extra yield is in emerging markets fixed income. But when the Fed raises rates, that usually hits emerging markets pretty hard. So what are you doing in EM? And also, what are you doing with those currencies?
Well, EM is almost like a very high beta way to play the Federal Reserve. So if interest rates start to rise in the U.S., then EM could be a little bit treacherous because EM is going to follow the Fed cycle to some degree. However, if you think the pace of Fed rate hikes will be slow, which is what we think, then we think that EM could actually have some pretty decent value. So, you mentioned currencies. Currencies is a very, very important component to emerging markets. The local debt, which obviously will be priced in the local currency terms, we would argue that you probably want to hedge that out. So we still think that dollar strength is going to be pretty good, and it's going to continue to strengthen throughout the year. So we do like the local bonds. We like a lot of the exposure that EM can get you to earning higher yields, but you've got to be careful with the currency. And if you hedge out the currency properly, and even what we like to do is have a longer dollar overlay in a lot of these strategies where if yields do rise and the dollar strengthens, then we feel as though we're relatively well hedged against any downdrafts that EM might provide.
And then finally, speaking of hedging currencies, talk about the developed markets. What about Europe? You want to buy any Greek bonds if you want any yield?
Well, the fund that we manage is called Global Fixed Income Opportunities, which is the unconstrained fund that I was discussing earlier. In this fund, what we think is that you can take interesting bets in Europe. The way that we like to think about it is almost like playing one monetary policy cycle against the other. So if the Fed may be increasing interest rates, whereas the ECB is going to keep rates low for a long period of time, maybe even lower rates further, and also with quantitative easing, buying bonds, we think that there's many opportunities, particularly within the financial sectors and investment-grade corporates, even the peripheral bond markets, the Italys, the Spains of the world. You mentioned Greece. Greece has its issues right now, so we're not overly exposed to Greece at this point. We think that we need to be cautious with Greece. We think there may come a time when Greece could be a good investment, but we think that at this point we probably would rather do other things in Europe. Italy, Ireland, Portugal. Portugal is a great place. We think that a lot of the structural reforms, a lot of the economic developments within Portugal are leading to pretty positive returns. So, the Eurozone is a very interesting place to be right now.
All right. Thanks a lot for coming on.
Thank you very much.
And thank you for watching The Street.